If you've ever Googled how to start investing, you've probably seen both index funds and ETFs thrown around as the smart choice for beginners. But which one is actually better? While they look almost identical on the surface, there are small differences that can make a huge impact on your long-term wealth. Today, we'll break down exactly what they are, their key similarities and differences, and which one might be the better fit for your portfolio. But first, a quick disclaimer. This video is for educational purposes and is not financial advice. Let's dive in. Let's start with index funds. Imagine you want to invest in the stock market, but you have no idea which companies to pick. Should you buy Apple, Tesla, or play it safe with Coca-Cola? The truth is, nobody really knows which single stock will perform the best. That's where index funds come in. An index fund is essentially a giant basket holding many different stocks. Usually, it's designed to track a specific market index. For example, an S&P 500 index fund owns shares in all 500 of the biggest U.S. companies, from Apple and Microsoft to McDonald's and Walmart. By buying just one share of that fund, you instantly get a small piece of all those companies. So, if the overall market goes up, your investment goes up too. Because index funds are passively managed, meaning they simply copy the market rather than relying on expensive managers, they come with very low fees. Most charge an annual expense ratio of just 0.02% to 0.20%. That means if you invest $1,000, you could pay as little as 20 cents to $2 a year in fees. One thing to remember, index funds are priced only once a day. At the end of each trading day, the fund calculates its net asset value, or NAV. No matter when you place your order during the day, you get that end-of-day price. Another benefit of index funds is how they're treated for taxes. This depends on where you live. In some countries, like Spain, you can switch from one index fund to another, say from an S&P 500 fund to an international stocks fund, without triggering a taxable event. That means your investments can grow tax-deferred until you cash out. In the U.S., selling one index fund to buy another is usually considered a taxable event, so you'd owe capital gains taxes. Still, index funds are extremely popular for retirement accounts and long-term portfolios. Major providers like Vanguard, Fidelity, and BlackRock offer them. Now, let's talk about ETFs, or exchange-traded funds. On the surface, they seem almost identical. An S&P 500 ETF also gives you exposure to all 500 large U.S. companies in a single investment. Where ETFs stand out is that they trade on stock exchanges just like regular shares. This means you can buy or sell them anytime during market hours. Their price changes constantly based on supply and demand. This gives you more flexibility and control over your entry and exit points compared to index funds, which only price once per day. Visual, timeline showing 1993 and the launch of SPY. ETFs are relatively new. The first one in the U.S., SPDR, or SPY, launched in 1993, and it remains one of the largest in the world. Most ETFs are passively managed, tracking an index, but there are also actively managed ETFs, where professional managers pick investments to try to beat the market. Let's take a look at a popular ETF, Vanguard's S&P 500 ETF, ticker symbol VOO. It's passively managed and uses full replication, meaning it owns almost all the stocks in the index, giving you the true market basket. Its expense ratio is tiny, just 0.03%, making it one of the cheapest funds you'll find. The largest companies by market capitalization, like Apple, Microsoft, and Amazon, make up the biggest portion of the fund. VOO also distributes dividends, usually every quarter. Some ETFs, called accumulating ETFs, automatically reinvest dividends back into the fund for you. Before we wrap up, let's bust some common myths. First, an ETF isn't automatically better than an index fund. The intraday trading flexibility isn't always useful for long-term investors. Second, Actively managed ETFs rarely guarantee higher returns. According to Morningstar, only about 3 out of 10 active funds beat the market over the long term. Finally, ETFs are not risk-free. They're only as safe as what's inside them. If an ETF tracks volatile sectors like tech or crypto, it can swing just as much as individual stocks. So, which is better? It depends on your investing style. For long-term investors, both index funds and ETFs offer low-cost, diversified exposure. ETFs add flexibility, while index funds offer simplicity and often tax advantages. No matter which you choose, the key is starting early and staying consistent. That's how you build wealth over time.